Forget everything the commentators said on Saturday. Forget the emotional reactions, the blame, the speculation about who caused it and why. None of that matters now. What matters is something far older, far more reliable, and far less comfortable than any opinion currently circulating on social media. The market did not break on Friday. It had already been breaking for months. The fracture lines were there, visible to anyone who understood the language of historical data, but the crowd had long stopped listening to that language. They had replaced it with something far more dangerous: confidence without calculation. Every collapse has a skeleton. Beneath the headlines, beneath the panic, beneath the screenshots of shattered portfolios, there exists a mechanical structure, a precise sequence of events that did not happen by accident. And this skeleton was visible for months before Friday opened the trapdoor. The question is not why the market fell. The question is why, despite 140 years of identical warnings, almost no one saw it coming. To understand what happened in January 2026, one must first travel backward. Not weeks or months, but decades. Because the pattern that unfolded in the commodities market this past Friday is not a new story. It is an old story, retold with different numbers, but the same structure, the same psychology, and the same devastating consequence. And 140 years of recorded market data confirms this with uncomfortable precision. Throughout 2025, the commodities market, gold, silver, platinum, palladium, and the broader spectrum of traded metals, experienced a sustained upward movement that lasted approximately 14 months. During this period, institutional investors increased their leveraged positions at a rate not seen since 2007. Retail traders followed, drawn by the consistency of returns and the widespread narrative that precious metals had entered a permanently bullish cycle. This narrative was not built on economic fundamentals. It was built on momentum. And momentum, as history has repeatedly demonstrated, is one of the most unreliable foundations upon which to construct financial strategy. By the third quarter of 2025, margin positions in the commodities sector had expanded by roughly 40% compared to the previous year. Hedge funds were holding concentrated long positions. Trading algorithms were calibrated to buy on dips, reinforcing the illusion of stability. The market had become, in structural terms, a system designed to move in one direction, until the day it could not. The warning signals were not hidden, they were simply inconvenient. The first indicator appeared in mid-2025, when the ratio between speculative long positions and actual physical demand began to diverge at a historically abnormal rate. In plain terms, the number of bets being placed on rising commodities prices far exceeded the number of buyers who intended to take physical delivery. This is a pattern that preceded the commodities collapses of 1929, 1973, and 2008, each time by a margin of 6 to 12 months. The second indicator was the behavior of central banks. Several major economies began quietly reducing their gold reserve purchases in the second half of 2025, a shift that went largely unreported in mainstream financial media. Central banks are not infallible, but their purchasing behavior is one of the most closely tracked signals in commodity markets. When they pull back, it often signals that internal risk assessments have shifted, a fact that retail investors and many institutional traders chose not to examine. The third indicator was volatility compression. Throughout the summer and early autumn of 2025, price swings in the commodities market became unusually narrow. The market appeared calm, but in historical analysis, periods of prolonged low volatility in commodities have consistently preceded sharp, violent corrections. Calm markets do not eliminate risk, they store it. There is a precise point in every market cycle where sentiment overtakes analysis. It is the moment when traders stop asking, "Is this price justified by data?" and begin asking only, "Is this price still going up?" That moment arrived in the commodities market in October 2025. During that month, gold prices reached levels that exceeded fundamental valuations by a significant margin according to multiple independent economic models. Yet buying continued, not because the models were wrong, but because no one in the dominant market conversation was referencing them. The conversation had become entirely about price action, entirely about momentum, and entirely disconnected from the structural realities that 140 years of data had repeatedly proven to be the only reliable foundation for long-term market behavior. The trapdoor was already built. Friday simply opened it. The market did not fail. It performed exactly as it has performed in every comparable cycle across 14 decades. The only variable that changed was how many people chose not to see it coming. Every collapse has a skeleton. Beneath the headlines, beneath the panic, beneath the screenshots of shattered portfolios, there exists a mechanical structure, a precise sequence of events that did not happen by accident. The great commodities crash of 2026 was not chaos. It was a system executing exactly the way fragile systems execute when the weight placed upon them finally exceeds their capacity to hold. Understanding that skeleton is not optional for serious decision makers. It is essential. The first domino was not visible on any chart. Most market participants believe crashes begin with a price drop. They do not. They begin with a decision, usually made quietly, usually made by institutions operating with information that retail traders and even mid-level analysts never access in real time. In the weeks leading up to the Friday collapse, several major institutional investors began reducing their exposure to commodities positions. This did not generate headlines. It did not trigger alarms. It happened through a gradual, methodical rebalancing of portfolios, the kind of movement that blends seamlessly into normal market activity. But the direction was deliberate. The timing was not coincidental. These institutions had been monitoring the same divergence signals that historical data had flagged months earlier: the gap between speculative demand and physical demand, the compression of volatility, the unsustainable ratio of leveraged bets to actual market fundamentals. They did not wait for the market to correct itself. They repositioned before it did. This is how institutional capital operates. It does not react to crashes. It moves ahead of them. The mechanism that turned a correction into a collapse. Once institutional withdrawal began, the next phase activated with mechanical precision: margin calls. For context, a margin call occurs when a leveraged trader's account loses enough value that the broker demands additional funds to maintain the position. If the trader cannot provide those funds, the position is automatically liquidated, meaning it is sold at whatever price the market offers at that exact moment. This forced selling creates immediate downward pressure on prices, which then triggers additional margin calls in other accounts, which triggers more forced selling, and so on. This is not a theory. It is a documented chain reaction that has appeared in every major commodities crash across the past century. The 2026 event followed this pattern with textbook consistency. On Friday, the initial price movement in gold was moderate, uncomfortable, but not yet alarming to most traders. However, within the first 90 minutes of aggressive selling, leveraged positions began hitting their margin thresholds. The liquidation cascade that followed was not driven by fear or sentiment. It was driven by mathematics. Brokers do not negotiate. Algorithms execute. And the speed at which this cascade unfolded left human decision-making entirely irrelevant. Silver, already positioned at elevated price levels with thin liquidity compared to gold, experienced a disproportionately violent drop. Platinum and palladium followed the same trajectory. The entire precious metal sector did not fall together because of shared sentiment. They fell together because their leveraged positions were interconnected within the same institutional clearing systems. The role of the dollar and interest rate policy. The crash did not occur in isolation. It occurred within a macroeconomic environment that had quietly shifted in a direction unfavorable to commodities. Throughout late 2025 and into early 2026, the U.S. Federal Reserve maintained a posture that signaled sustained higher interest rates for longer than the market had initially priced in. A stronger dollar, which moves inversely to commodities prices in most historical cycles, had been gradually appreciating, another signal that was present in the data but absorbed into the background noise of a market focused exclusively on upward momentum. When the institutional withdrawal began, these macro forces did not merely accompany the decline, they accelerated it. Capital flows shifted from commodities back into dollar-denominated assets, withdrawing liquidity from an already destabilizing market at precisely the wrong moment. The system did not malfunction. This is the critical point that most post-crash analysis will miss. The commodities market on Friday did not break down. It functioned exactly as designed. Leveraged systems amplify gains during expansion and amplify losses during contraction. That is not a flaw. That is the architecture. The real failure was not mechanical. It was analytical. It was the widespread decision made by millions of participants over 14 months to treat a leveraged, sentiment-driven market as though it were a stable, fundamentally sound one. The skeleton was always visible. The only question was whether anyone chose to study it before Friday forced everyone to. Forget everything the commentators said on Saturday. Forget the emotional reactions, the blame, the speculation about who caused it and why. None of that matters now. What matters is something far older, far more reliable, and far less comfortable than any opinion currently circulating on social media. What matters is the data itself, and the data has been keeping records for 140 years. History does not repeat, but it does something arguably more useful. It rhymes. And when you align the current crash against every comparable commodities collapse since 1886, a pattern emerges that is too consistent to dismiss and too uncomfortable for most market participants to accept. The 5 crashes that taught us everything to understand what happens next. One must first understand what happened before. Not one crash, not 2. 5. Each separated by years, by decades, by entirely different economic climates, yet each carrying the same structural fingerprint in its aftermath. The first was 1929. The commodities sector, deeply intertwined with agricultural and industrial markets, experienced a collapse that preceded the broader stock market crash by several months. The recovery did not arrive for nearly 3 years. The market did not simply bounce. It ground downward in stages, offering false recoveries that lured investors back in before resuming its decline. The second was 1973. Triggered by the oil embargo and a broader inflationary shock, commodities markets experienced a sharp contraction that lasted approximately 18 months before stabilizing. The critical observation here is not the length of the decline, but its shape. A rapid initial drop, followed by a prolonged period of sideways movement before any sustained recovery materialized. The third was 1986. Oil prices collapsed by nearly 60% within a single quarter. Precious metals followed, though at a slower pace. What the data from this period reveals is a phenomenon that analysts at the time did not fully recognize: the dead cat recovery. Prices rebounded sharply in the months following the crash, creating the illusion of a V-shaped recovery before resuming a gradual decline that lasted another 2 years. The fourth was 2008. This collapse is the most studied and the most misunderstood. Gold, which many believed would act as a safe haven, initially fell alongside everything else. It was only after the acute phase of the crisis had passed, after liquidity dried up and fear peaked, that gold began its recovery. The lesson here is precise. In the earliest stage of a commodities crash, even traditionally defensive assets do not behave defensively. They behave predictably. The fifth was 2020, the fastest commodities collapse in modern history, driven by demand destruction during global shutdowns. The recovery was equally rapid, but that speed was entirely artificial, manufactured by unprecedented monetary stimulus. Remove the stimulus, and the underlying fundamentals of that recovery were far weaker than the price action suggested. The pattern that 140 years cannot deny. When these 5 crashes are placed side by side, not by their causes, but by their behavior in the months immediately following the initial drop, 3 consistent phases emerge. The first phase is capitulation. This is the period where the sharpest selling occurs, where leveraged positions are fully liquidated, and where the maximum number of participants exit the market entirely. In every recorded instance, this phase lasted between 2 and 6 weeks following the initial crash. The second phase is false stabilization. Prices stop falling and begin moving sideways or slightly upward. This movement is not driven by genuine demand or improved fundamentals. It is driven by technical buying, algorithmic repositioning, and the psychological need of remaining market participants to believe the worst is over. In 3 of the 5 historical crashes studied, this phase lasted between 2 and 4 months. The third phase is the divergence point. This is the moment where history splits into 2 possible directions, and the direction it takes depends entirely on the macroeconomic conditions present at that time. In 1929 and 1973, the divergence moved downward into prolonged bear markets. In 2008 and 2020, it moved upward into sustained recoveries. In 1986, it moved sideways for an extended period before eventually recovering, where 2026 currently sits. The crash of January 2026 has completed its initial drop. Based on the structural similarities to the 5 historical events analyzed, the market is now entering what the data suggests will be the capitulation phase. The critical question, the one that no amount of commentary can answer, but that 140 years of data has consistently informed, is which direction the divergence point will take when it arrives. That question has an answer, and it is not the one most people want to hear. This is the moment most videos avoid, not because the answer does not exist, but because it is not clean, not simple, and not the kind of conclusion that generates optimism or easy reassurance. The data does not care about comfort. It cares about consistency. And after 140 years of consistent behavior across 5 comparable crashes, the commodities market in 2026 is pointing toward a future that serious decision makers cannot afford to ignore, regardless of whether it aligns with what they want to believe. The 2 scenarios. The data supports history does not offer certainty, but it does offer probability. And probability, when grounded in 140 years of verified market behavior, becomes one of the most powerful tools available to anyone making strategic decisions in an uncertain economic environment. Scenario 1 is the controlled recovery. In this path, the commodities market follows the pattern observed in 2008 and 2020. After the capitulation phase concludes, which historical data suggests will occur within the next 3 to 6 weeks, prices stabilize, sideways movement begins, and within 6 to 12 months, a gradual upward trajectory emerges. This scenario is supported by one critical condition: sustained monetary policy accommodation from major central banks. If interest rates are reduced, or if quantitative measures are reintroduced to stabilize liquidity, this is the most likely outcome. The recovery, however, would not be rapid. It would be slow, uneven, and marked by significant volatility, nothing like the sharp rebounds that dominated headlines in previous cycles. Scenario 2 is the prolonged decline. In this path, the market follows the pattern observed in 1929 and 1973. The capitulation phase completes, a false stabilization period creates the illusion of recovery, and then prices resume a downward trajectory that extends beyond 18 months. This scenario is supported by one equally critical condition: continued tight monetary policy, a strengthening dollar, and persistent inflation that erodes purchasing power without generating the kind of crisis response that historically triggers aggressive stimulus. If these macroeconomic conditions remain intact, the current crash is not the bottom. It is simply the most visible moment in a longer structural decline. Which scenario is more likely? The data does not assign percentages, but it does assign weight. And when the current macroeconomic environment is compared against the conditions that preceded both outcomes across historical cycles, the evidence leans, not decisively, but meaningfully, toward a prolonged period of instability before any genuine recovery materializes. The reason is straightforward. In every historical instance where commodities recovered quickly, the recovery was catalyzed by a significant policy shift, either massive monetary expansion or a fundamental change in the geopolitical conditions driving demand. As of this analysis, neither condition is present. Central banks are signaling patience, not intervention. Geopolitical demand drivers remain unchanged, and the dollar, which moves inversely to commodities in most historical cycles, continues to strengthen. This does not mean commodities will not recover. They will. They always have across every cycle studied. But the timeline, based on current conditions, is more likely to extend into the 12 to 18-month range rather than the rapid 6-month recoveries that characterized stimulus-driven rebounds. What this means for serious decision makers: this is not financial advice, it is structural analysis, the same kind of pattern recognition that has informed economic strategy for generations. But the implications are clear enough to act upon intellectually, even if no specific trade or investment is being recommended. First, the market has not yet found its floor. The capitulation phase is underway, but historical data suggests that the lowest price point in comparable crashes was rarely reached during the initial drop. It was reached weeks later, during the quiet period that followed. Patience, in this context, is not passivity, it is strategy. Second, the false stabilization phase will create pressure to act prematurely. When prices stop falling and begin moving sideways, the psychological pull to re-enter the market will be significant. Every historical cycle studied confirms this, and in every cycle where participants acted on that impulse too early, the subsequent decline erased whatever gains the false recovery had temporarily provided. Third, the businesses and entrepreneurs who emerge strongest from this period will not be the ones who predicted the crash most accurately. They will be the ones who used the disruption to reposition, to reduce exposure to volatility, to strengthen cash reserves, and to identify opportunities that only become visible when an entire sector is repricing its fundamentals from the ground up. The commodities market did not crash because the system failed. It crashed because the system worked exactly as it always has. The only difference between those who survive these cycles and those who do not is whether they understood the pattern before it forced them to learn it.